We work so hard to save the money and invest. Now, once we have a satisfactory corpus, how to use this money to extract a second or passive monthly income? Hello and welcome to our channel 5-Minute Finance by ET Money, where we talk about the basics of investing and personal finance. In today's video, we'll discuss some popular investment options which will help you avail monthly income. So let's quickly dig into the different options one by one. Post Office Monthly Income Scheme or MIS is a government-backed scheme, so the risk is almost zero. You can invest in this scheme to get monthly income. You can invest minimum 1,000 rupees to up to 9 lakh rupees individually and rupees 15 lakh under a joint account. The interest rate is reviewed quarterly by the government. Currently, it is 7.4% per annum. Your interest will be the interest rate at the time of deposit and will remain fixed for the tenure of next 5 years. You can renew the scheme after 5 years. So suppose you have invested 9 lakh and then at the rate of 7.4% per annum, your interest for the year will be 66,600 rupees. You'll get a monthly interest of 5,550. Now remember, the interest is fully taxable. Senior Citizen Savings Scheme, as the name suggests, is a special investment scheme for those aged over 60 years. It is a 5-year scheme backed by the Government of India. Therefore, risk is nil. After 5 years on maturity, the account can be extended for another 3 years. Now, the senior citizens can invest up to 30 lakh rupees and the interest is decided by the government on a quarterly basis. Currently, it is 8.2%. The interest payout is also quarterly, and here again, the interest is fully taxable. Corporate deposits, also known as corporate fixed deposits, FDs, are the fixed deposits offered by companies at a fixed interest rate for a set period of time. They are issued by housing finance companies and non-banking financial companies. Now, corporate FDs often have higher interest rates than bank FDs, but the risk is also higher. If the companies are not able to pay interest, there is not much investors can do. In fact, there is a risk of loss of principal as well. Now, corporate FDs are not covered by the Deposit Insurance and Credit Guarantee Corporation that provides insurance cover of up to 5 lakh on bank FDs. So you should research properly and assess the risks before investing. You may also look at the ratings assigned to corporate FDs by recognized rating agencies like CRISIL, CARE and ICRA. The rate of interest can range between 7 and 10% per annum depending on the issuer. The interest earned on the corporate deposits is taxable and TDS may be deducted if the interest earned exceeds 5,000 rupees in a financial year. Annuities are offered by life insurance companies like LIC, HDFC Life, ICICI Prudential, etc. Here, a policyholder pays a lump sum to the insurer against which a regular payout is made to the individual at a pre-decided rate by the insurance company. For instance, LIC has this Jeevan Shanti plan, and we particularly look at a variant called the Deferred Annuity Plan. Now, the way this works is, let's say someone purchases an annuity for 10 lakh rupees at the age of 53, against which a payout of 1 lakh is made every year after a deferment of 7 years. It means an amount of 1 lakh is paid when the annuity buyer is 61 years of age, and for the terms of the contract, he or she continues to receive a lakh of rupees every year until he or she dies. And that's how the simple annuity plan works. Now, there are many variants of the annuity plans, and also while some insurance companies give a higher monthly annuity, some offer a much lower number depending on their internal calculations. So do your research before you decide to opt for one. The interest is fully taxable in the hands of investor. Next option is SWP from mutual funds. You can do SWP from debt funds. SWP is the opposite of systematic investment plan, that is SIP. Now, under this, you withdraw a fixed sum from the fund on a regular basis, say monthly. A debt fund is a type of mutual fund that places your money in fixed income instruments such as government securities, corporate bonds, and money market instruments. These are generally considered safer than equity funds. Currently, different categories of debt funds are offering average returns between 6.67% and 12.36%. However, the returns are generally predictable around 6 and 8%. And well, sometimes they can be lower as well. And we have already created a detailed video on how to get monthly income from mutual funds. You may watch it after this video. Then there are other mutual fund options like balanced advantage funds, where you can use the SWP option as well. Now, as the name suggests, these bonds are issued by the government to raise money from time to time. The tenor can be different and the interest will vary depending on the tenor of the paper and interest rate scenario. You can invest in them through retail direct platform. The interest will be fixed and guaranteed for the tenor. The interest is fully taxable in the hands of the investors. Now coming to the most interesting and favorite option of investors, you can invest money in property to generate monthly rental income, but it is generally seen that rental yield of the residential property is between 2 and 4%, while on the other hand it is around 7 to 8% in case of commercial property. But to buy any kind of property you need a big investment, plus you must do proper research before buying as it is a big investment. So all these investments can help you earn a monthly income, but they have a varied degree of risk and reward. No one option is suitable for all. So basis the level of risk you want to take, decide which option suits you the best. And it's a wrap. Don't forget to share this video with your friends and family and do subscribe to our channel.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.